December 1, 1991. Real Estate Capital Basics, Underwriting Construction Loans. Basic underwriting parameters for construction loans are outlined as follows. Property types. Most categories of to-be-built property able to reasonably demonstrate generating income. Conventional property types, multifamily, industrial, office and retail, most desired, followed by lodging, healthcare and recreational properties. Multifamily, apartments, including affordable, luxury, manufactured housing communities, age-restricted, senior living, and student housing. Net lease, all property types acceptable for credit-tenant facilities. Conventional commercial properties, industrial, warehouse, manufacturing, flex/tech, self-storage, office, medical, and retail, mall, community, neighborhood and specialty centers, mixed-use and parking structures. Non-conventional, lodging, healthcare and recreational, golf course, waterpark. Dollar size/investor profile. Investors range from individuals looking for real estate investments to institutional investors who routinely take equity positions in real estate ventures. Some institutions purchase for cash, supplying 100% of the necessary equity, while others leverage their purchases, using debt funds from other sources. Insurance companies have long been a major force in the real estate lending industry. Recently, however, they have become less willing to accept fixed yields on the funds they commit to real estate ventures. In order to increase the return on their portfolio of real estate investments, they purchase property to benefit from expected increases in cash flows and property value over the life of the investment. Under $5 million governed by local players with hands-on management including families, contractors and adjacent property owners seeking more real estate diversification. Mostly casual or part-time investing with limited financial sophistication. $5 million to $30 million attract professional local and regional players having market presence in the general area. More sophisticated financial analysis and full-time resources dedicated to operations. Funds usually syndicated, often including wealthier individuals. $30 million or more attracts institutional investors hiring professional management. Larger publicly traded and private investment syndicates emerge as common players. Rate. Floating rate, 200 to 300 basis points over selected LIBOR for closed-end, conventional properties based on adequate equity contributions. Other non-conventional projects are priced as much as 300 to 500 basis higher. Alternatively, smaller banks and select financial institutions priced at bank prime rate to as much as 300 basis points premium for respectively increased risk. Fixed rate, equivalent to forward delivery, fixed rate debt typically offered by life companies and agencies, FHA/HUD, as combined construction/forward programs. Lower rates traded for higher commitment fees, more equity, pre-leasing and stronger sponsorship. Term. Equal to project construction rehabilitation period, typically 6 to 24 months. As a popular option, additional 6 months to 3 years offered for project stabilization, a combined term of as much as 5 years. Payment schedule. Interest only, to a lesser extent, 20 to 30-year amortization schedule. Accrual optional, typically 10% of total loan is a maximum limit. Exclusively used for loan sizing, not actual payments. Stress test underwriting payment schedule includes 20 to 30-year amortization. Loan to cost. Dependent upon takeout commitment funding availability. 70% to 80% typical, although 90% or more of cost available for substantially pre-leased projects, while 50% to 70% required for higher-risk developments. Disbursements based upon work completed or in process, rather than loan commitment amounts. Financing fees. 1% or less for larger deals with takeouts. 1% to 3% or more for smaller and open-ended deals. Additional terms. Construction loan can float beyond initial terms with financially sound sponsorship. Personal guarantees required, but may be removed based on performance thresholds linked to physical completion and economic performance. Open-ended construction lenders frequently have right of first refusal for arranging interim and/or permanent financing. Completion holdbacks of 10 to 25% of contract amount for construction. Various plans for amount and timing of disbursements, also known as advances, draws, progress payments, and payouts.